As tough it is to look at the indices and say, wow, how is the NASDAQ, up on the year, what, 5, 6, 7%. But the overall broader market, the concerns, the unemployment claims, but really got to take a look at it. The tech that's behind allowing people to kind of go through what they can on a daily basis it has ultimately what's benefiting. I mean, you're seeing everything from Microsoft to Apple, but in Amazon to some of these newer techs that have younger companies that have really benefited from these lockdowns. And that's sort of why we're seeing such a discrepancy between, or divergence between, what the NASDAQ has done and say the small caps. Now, at this point, there's no reason to think that the NASDAQ can't make a new all-time high. And the small caps or even the Dow is going to continue to trail that drastically. So I think I'd be prepared for that. Looking at the S&P that has a lot of exposure to those big tech behemoths and other techs as well, the 200-day moving average is just below 3,000. So that still is a ceiling that you got to keep an eye on as we stay just below there and potentially kind of fall back a little bit from this resistance.
Yeah, I mean, you hate to be cranky, and obviously, Bill, there are businesses that are real, and they're capitalizing on some, not just current conditions, Amazon being one of them, but also that will continue to operate from a position of strength. But a PE of 117 sets me back a little bit. So at some point, you have to say, when the market gets disconnected from what we know to be how it should trade, should in quotation marks, I suppose, or what we understand to be kind of fundamental pricing mechanisms, should we just be worried? Is that cause for concern no matter what?
Well, absolutely. And that's a great point. I learned a long time ago that the market, Mr. Market, is always right and can remain irrational longer than you can remain solvent. So that has to play into your investment thesis, too. And one of the things that we're looking at, and I've been hitting the table with, is looking at the treasuries. I do think that the treasury prices are going to make a new high. Yields are going to make a new low. The Fed is out there. Jerome Powell, the Fed chair, is going to talk here in 20 minutes. The Fed is out there saying more measures are going to be needed to stabilize the economy. They're saying they're going to print more. And over the 60 Minutes interview that really got this rally going this week, he said, don't bet against the U.S. economy. So the Fed's going to do more. And what we're probably going to see is sort of a move in yields similar to what we saw ahead of the QE3, a new low in those yields, a new swing down. So I'm positioned long in the Treasury complex. And I think that's a way to capitalize it. There's rationality there. We've had a lot of supply through these Treasury auctions. The U.S. Treasury has put that up over the past 10 days. And the market, more supply you would think would push the market lower. The market is buoyed still, and the 30-year bond holding strong support. So I think what we're seeing is a setup in Treasury prices to make a new high. Those Treasury yields will make a new low. That's the rationality. And what could be a tailwind for those prices is if the market has more rationality and the stock market comes in a little bit, which I imagine it should. But again, you can't fight those techs.
So then let's talk about just in terms of that Treasury trade. We look at the 10-year around 0.6%. How low does it go? What are you kind of betting on? And then part two of that question will be, how long is this trade for you?
Well, the 50 basis points has been sort of a psychological, buoy area for the 10-year. I do think that the 10-year is going to hit closer to zero on some sort of a washout if that plays out. And I imagine that zero is going to get hit especially if the equity market sees quite a bit of pressure too. I'm playing it by being long the 30-year bond. We also have positions long in the 5-year Treasury note, the shorter end of the curve. We have a trading program that's up about 6% this year and up about 17% over the last year. And we have positions long the 5-year Treasury note in that. My timeline on this is similar to looking at what's taking place this year as what took place between 2008 and 2014, where I had mentioned QE3. We saw Treasury yields every time the Fed had hit QE1, QE2, and QE3. We saw Treasury yields bottom within 30 to 60 days. And I think we've seen similar essences of that in a more compact timeline over the past couple months. So I do think that this sort of QE3, call it, that's going to happen when the Treasury when the Fed delivers more stimulus. We're going to see a new low in those yields, similar to what we saw in QE3. And then coming out of that, though, that's sort of what we're going to see is the new growth phenomenon that's going to be. We're going to see inflation. We're going to have a little more figured out, and I think that's going to be closer to Q4. That's where the yields rise. I think we're going to see a really good push higher in yields, but it doesn't mean the stock market needs to sell off. I think ultimately the stock market is going to move higher with that. I think the Treasury market the Treasury prices will move lower, and the stock market move higher, as it is traditionally seen. So out of that also, I'm looking at the U.S. dollar. I think the U.S. dollar is going to perform very well in the back half of this year for that exact reason. If you look back at 2013 and 2014, which was where the taper tantrum was, Treasury yields rose. And then on the heels of that, as the Fed started unwinding unwinding their stimulus measures, which we could see early next year, ahead of that, the dollar rallies. So that's how I'm starting to position. I'm long gold. I'm using this dip in gold to be a buyer. Yeah. I'm long gold, I'm long treasuries, and I'm long the dollar.
Okay, well then that's my last question to you. Actually, to me, the 10-year at zero is an end of the world trade, which suggests you should be long gold. Do you also get out of gold by Q4 if that's your thinking around when treasuries turn?
You know, I do think that is going to be sort of the move. I think what we're going to have here, June gold options do expire next week, but the June gold futures contract at the end of next week. And it's very typical to see once these futures contracts expire, you do see a move. Just last year when the June contract expired in gold ripped higher the next day. And I think that's this weakness we're seeing here in gold is happening ahead of that contract expiration. So I want to be long gold into this next week, and I think it's going to be a rally in through August, potentially maybe as late as September, which we've seen before. And then seasonally, gold does start to weaken October, November, and then in the first half of December. So I would not want to be long gold in the Q4 up until the second half of December, when I would then position long gold again.